So private markets are doing what they normally do, which is do this navigation very clearly, very slowly, taking their time to make their decisions. Nothing's done, as you'll find out, nothing is done in a rush in private markets. And kind of the way we think about it is, almost thinking about they're still the same company, the same businesses, making the same thing that people buy. But if you think about kind of the volatility of private markets versus public markets, think of it as it's a calmer ocean versus the tumult of the ocean seas for the noisier public markets.
You say that, but then you look at the private equity stocks in the U.S. and in Europe, and they took a real beating in the last week. I think there was a lot of concern that we could see an accident, like we were just hearing from Mark Rowan talking to Andrew Ross Sorkin, that we could see a financial accident, and it might happen in the private space, private credit specifically. What are your thoughts?
I mean, Mark's spot on, as he always is. I think the way that both private credit and private markets, private equity mitigate that is through very careful, as I said, slow decision making, tending to not to rush into things. So, and then what we've seen, certainly post-COVID, is very disciplined financial analysis and making sure you've got the right buffers in place before you've got that deal done. So, I think that the market and the participants are probably much better at managing these shocks before they happen. That's not to say we won't see a shock, but I suspect it's more likely to come from more of the public markets than necessarily the private markets.
What about deal flow? How is deal flow for private equity funds likely to be impacted by the events of the last week?
Yeah, so look, pre-Liberation Day, as we sort of pre and post-Liberation Day, we've seen very healthy deal flow returning to the market. I think clearly it's going to take a pause. You're going to see private equity GPs just taking their time to go through their due diligence. Then there's a lot of these deals, there's no rush to execute. So we've seen extraordinary degrees of resolution over the last 24 hours, the last 12 hours. I think that will restore some of the spirits within deal flow. But I think on a 3-month, i.e. a very short-term view in private market space, I think clearly we'll see some impact on deal flow.
It's interesting, you talk about no rush to execute deals, and fair enough, but there is pressure to exit a lot of these investments, with a lot of LPs under pressure, liquidity pressure, trying to extract funds here. So what is the plan, given the IPO market looks effectively shut? And correct me if I'm wrong, but I don't see it opening anytime soon, given the level of uncertainty that remains.
I think you're spot on, you're right. The IPO market remains a very fickle beast to manage. But there are two elements here that I think work in private markets' favour. One is, clearly we've seen different routes to exit really manifest themselves, particularly over the last 5 years. And I'm thinking particularly continuation funds, which are what we call GP-led deals. So I think we'll see a lot of exits that might have been primed for the public markets go out in either single or multi-deal exits into LP-backed and GP-backed continuation funds. I think that's very healthy for the industry. And kind of the other dynamic here is that GPs will be under pressure from LPs to make sure these exits happen, and I think you'll actually see the private equity industry responding quite healthily to that over this year, and making sure we try and get those exits, whether that's in the public markets, which is going to be tough, but there is a queue of very good deals waiting to come out. And I think that window has probably gone out a little bit more. But continuation funds, I think, will still see deals done, and will GPs really focused on getting distributions back to LPs at what is a crucial time for the private markets industry.
What does that mean for pricing if we don't have the competitive pressure from public markets being a viable exit option? What kind of pricing discounts are you looking at with secondaries?
So if you look at the secondary market anyway, we've seen, certainly over the last 6 months, a tightening of secondary spreads. So, into sort of mid to high single-digit figures, which have closed over the previous 18 months from being quite wide. My sense is that you will see spreads widening, but actually that won't lock down until we actually start to see some prints of deals done. So, I suspect that we'll see secondary discounts widening, which is great for the secondary market. Lots of very large secondary funds out there that have closed in the last 6 months, a year, who have significant amounts of dry powder to really swoop on some of those secondary deals. So if you're a secondary investor, a secondary manager, a really interesting place to be within the private market space at the moment.
What about AI as a sector? We had a guest on, our first guest of the program, talk about likening the current period that we're seeing in public markets and the volatility to 2000 and the bursting of the tech bubble. He says that he's seeing some signs of that in the AI space now. What's the general feeling and the appetite for AI deals in the private space?
It's still huge. I mean, AI is going to drive very significant commercial cost cutting across organizations, increased productivity. That genie is well and truly out of the bottle. I think it's going to continue to be a really exciting place with, deal multiples maintained. We've seen a little bit of compression, but certainly in the mid to high teens on EV to EBITDA multiples on AI deals. And I think most private equity, both GPs and LPs, are going to want to have significant exposure to AI within the portfolio. Look, it's transformational. It's kind of the three great things that have happened in the last, since the 1800s: Industrial Revolution, World Wide Web, and now AI. Just the gap between World Wide Web and AI a little bit tighter.